Hey guys, Chris from Tuition here, and in this video, I'm going to show you the solution for question 2 from the Jan 2014 PoA Paper 2. If you want to check out the solutions for the other questions on this paper, I'm going to put a card up there and a link in the description below. So be sure to check those out as well. And with that said, let's get into the question. Okay, so as per usual, we'll take a read of the information. So Golo Limited took inventory for the year ended 31st December 2013. The total of the ending inventory was $65,400 before the following errors were discovered. So one inventory sheet was overstated by $250. An inventory sheet total of $46.57 was transferred to the summary sheet as $45.67. Well, that's not a good thing. Free samples sent to the company by a supplier were included in the inventory at a cost of $75. An inventory costing $400 purchased from a supplier on the 27th of December 2013 was not included in the count. Now, what do they want us to do? It says, prepare a statement showing the correct inventory figure for the year ended 31st December 2013. Show clearly the effect of each item in the statement. That's with 6 marks. Okay, so let's take a look at what we have across here. So don't forget to head up whatever it is you're doing. Golo, statement of corrected inventory value for the year ended December 31st, 2013. Now, it's not a financial statement, so there's no one correct format. So the first thing we're going to start with is the value of inventory before the correction, $65,004, which we are seeing up here. The first item that we have to correct is that one inventory sheet was overstated by $250. Overstated means that the value is too high. If it's too high, in order to correct it, we have to subtract. So we're going to less, you're going to see less overstatement, or you can see less overstated value of inventory sheet. Doesn't matter what you put as long as it's correct. Okay. The next item says an inventory sheet total of $46.57 was transferred to the summary sheet as $45.67. So the figure that went to the summary sheet, is lower than the correct figure. Lower by how much? Well, to find that out, we have to subtract. So 46.57 minus 45.67 is 90. So it was too low. So in order to fix that, we have to increase. We have to add it. So you see add error of transposition, and you'll see the little work in here. So an error of transposition is where you mix up the digits of the figure and you use the incorrect figure with the digits mixed up to enter the information in the appropriate place. So of course, if you enter the wrong figure, you're going to have to fix it. All right, what's the next item here? Free samples sent to the company by a supplier were included in the inventory at a cost of $75. So if they sent you free samples, that's not for you to sell. That's for you as a supplier to check out and to make sure that the goods are up to par and that there's something you want to sell to your customers. So we include it in the inventory count, and it shouldn't be. So we are going to subtract that. So you're going to see less samples received from a supplier. And the last item says inventory costing $400 purchased from a supplier on 27 December 2013 was not included in the count. Okay, so if we bought inventory on the 27th of December 2013 and the current year end is the 31st of December 2013, why would it not be included in the count? So we omitted it. If we omitted it, we left it out. That means the figure is too low. And to correct that, all we have to do is add it in. So those are all of the errors, or the corrections, I guess you should say. And all we have to do is add and subtract going down as the case may be. And you're seeing corrected value of inventory, December 31st, 2013, $65,565. Okay, so that's part A. Let's take a look at part B. So it says that Golo Limited uses the last in, first out method of stock valuation. You are provided with the following information about one of the items of inventory for the month of December 2013. Okay, so we have a little table-like structure down there. So December 1st, we have beginning inventory, 100 units at $3 each. Okay. We have purchases, 2 sets, one on December the 2nd, 250 units at $350 each. On December the 15th, we also have another purchase of 100 units at $4 each. On sales, we have 2 sets of sales. December the 5th, we sold 200 units at $5 each. And on the 17th, we sold 175 units at $6 each. What do we have to do? Complete the stock valuation worksheet provided as an insert to calculate the value of the ending inventory for Golo Limited using the LIFO method. Okay, so what I did is I recreated that particular handout or insert or whatever it is. So we're going to switch across to that shortly. But before we do, if you are not too familiar or strong with stock valuation, I'm going to put a card up there with a link to my stock valuation video. And of course, you'll also find a link in the description below. So if, again, you need to check that out before you check this out, I strongly suggest you take a look at the video and then come back here. If, however, you feel comfortable enough with stock valuation, then let's proceed. Okay, so as I said, I recreated the insert. So you have your date column across on this side, you have your section for purchases, you have a section for sales, and you have a section for your closing balance after each of those movements, purchases and sales. What you're also noticing that I've done is I've pre-filled some of the information they've given us in the question. So we have the opening stock item here, we have the purchases figure from December the 2nd, then we have the sales on December the 5th, then we have the purchases on December the 15th, and the sales on December the 17th. And what we have to do is we have to fill out the worksheet, which means that we need to populate this section across here to show what happens to the composition and value of the closing stock after every transaction. So after our opening stock on December the 1st, we make a purchase of 250 more units at $3.50 each for a total value of $8.75. Our closing stock is going to be composed of two batches of stock. The first batch is the opening stock that we had from before, and the second batch is going to be, of course, the batch of stock that we just purchased. So you're going to see that there as well, and we're going to put some total. So this 350 is the total number of units, and this 1175 is the total value of all the units. And we're separating the batches because each batch has a different unit cost. The per unit cost for each batch is different, so we need to keep them separate under last in, first out. Now, we have on December the 5th a sale of 200 units at $5 each for a sales value of $1,000. Now, the sales value and sales price doesn't actually matter when we're doing our stock valuation sheet, because all we need to know is what's left. Now, under LIFO, LIFO means last in, first out. So we have two batches of stock. This batch was there first, this batch came in last. And the last batch in is the first batch out. So we're going to sell from this batch first. And then if we still need to sell more, we're going to sell from this batch after. Now, how many units are we selling in this sale here? We're selling 200 units. Now, this batch here has 250 units. So this batch can fully satisfy the required value or the required volume, the number of units for sales in this sale here, and still have 50 units left. And on top of that, the first batch of inventory isn't touched. So what that means is that the composition of closing stock after this sale of 200 units is going to be the following. We're going to have the same opening stock untouched because the second batch, the batch we bought on December the 2nd that had 250 units was enough to satisfy the sale of 200 units and still have 50 left over. And our total value that remains is now $4.75, composed of 150 units, 100 worth $3 each, and 50 worth $3.50 each. Now on the 15th, we are seeing that we buy 100 more units at $4 each. Now what does that mean for our ending inventory? Well, it means we're going to have three separate batches of ending inventory. The same opening stock, 100 at 3. Then we have the 50 units left from batch 2, and we have a fresh 100 units from, batch 3. So our total count would be 250 units, and we have a total value of $8.75. Now we have one more sale. We have a sale on the 17th of December of 175 units. Now we need to figure out what stock do we have left and what's the composition. Is it made up of one batch only, or is it made up of multiple batches? What is the composition and the value? Now under LIFO, last in, first, so we're going to sell from the last batch first. But check this. This batch that we just bought of 100 units, that's not going to be enough to satisfy 175. We're still going to have 75 more units to sell after that. Well, what are we going to do? So after we sell out this batch, we have to go up. We have to go to the next batch that came before that, which is this batch 2 from December the 2nd, but that only has 50, and we had 75 more to sell. So this entire batch is going to sell out, and we still need to sell 25 more units to make up the full 175. Because remember, it's 175 we're selling, and these two batches only account for 150. So we're still 25 short. Where's that going to come from? Well, the first batch of opening stock that was untouched all the time, it's going to come from there. And if you sell 25 units out of that batch, guess what? You're going to have 75 units left. And at a unit cost of $3 each, your total value of ending inventory will be $25. Okay, so there's one more part of this question, and it asks, would the value of ending inventory be higher or lower if Golo had used the first in, first out FIFO method? Okay, let's take a look back at our inventory sheet and I'll answer that question. Okay, so to properly answer that question, let's take a look at this collection down here. It shows all of the batches, albeit not all of the units because we sold some from the second batch. But the cost, I want you to look at the flow of the cost. What's happening to costs here as time goes by? We start off with $3, the next batch was bought for $3.50, and the final batch was bought for $4. So prices are increasing. So under LIFO, when we sell the more expensive batches first and are hence left with the cheaper batch at the end. However, under FIFO, the reverse happens. We sell from the first batch of stock and go down, which means whatever is left from the last batch in. And in a period of rising prices, the last batch in is usually the most expensive batch, which means that if we had used FIFO, we would have had 75 units left at $4, which would have given us a cost for inventory, a valuation of closing inventory rather, of $300. You can double check if you want. And that's higher than $225. And that's your answer. If we, as we have here in a period of rising prices, had we used FIFO to value to track inventory or as a cost flow assumption, what would happen to the value of ending inventory is that it would be higher under FIFO than under LIFO. Okay guys, so there you have it. That's the solution for question 2 from the Jan 2014 POA paper 2. If you have any questions, please feel free to let me know in the comment section below. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and be sure to check out my website where you'll find some POA handouts that you might find useful. Anyhow guys, as per usual, thank you so much for watching. Take care of yourselves and I'll see you next time. Bye.